can never be too prepared for unexpected moments. You never know when it's going to happen. Will you have the money you need to weather the storm? Maintaining access to your cash provides your family with additional safety. What will you do if you need more than you have available in your savings? Is the cash in your retirement account accessible? Can you borrow from your retirement account tax-free? If you could, what would you use it for? Do you need extra money for your child's college education? Do you need to pay down high-interest credit cards? Do you need a little extra cash for a down payment on a home? Whatever the reason is, it is always better to borrow money from your own investment, and it's even better if it's tax-free. Did you know that the only retirement plan that the IRS will allow you to borrow money from tax-free is a life insurance policy? Do you know how a life insurance policy loan really works? It's simple. As long as you keep your life insurance policy in place, you can borrow tax-free against the cash value without lowering the amount of money that is earning interest. Let's take a look at an example. Let's say that you have $100,000 invested in an indexed universal life insurance policy that was designed as a retirement account. When you decide to borrow against the policy, you can choose between a participating fixed-rate loan or a traditional matching loan. Let's say that you borrow $10,000 and choose a fixed-rate loan of 6%. You would owe $600 of interest during the first year. Even though you have borrowed $10,000, your entire $100,000 will continue to earn interest within your policy. Historically, IUL policies have had an average return of 7.5%, which would provide you with a $7,500 gain. If you deduct the 6% loan costs of $600 from your $7,500 return, you can see that you would have a $6,900 net return. If you do the math, you can see that even after you pay the loan costs, you still made a calculated 6.9% return on your $100,000. And the best part is that there are no minimum payments required to pay the loan back. Obviously, we are using historical average rates of return, and your returns could be higher and they could be lower. So let's take a look at a worst-case scenario. Most IUL policies have a guaranteed minimum return of 0 to 2%. If you chose a policy with a 1% guarantee, then the worst possible scenario would be a 1% return on your $100,000, giving you a return of $1,000. After you deduct the $600 loan cost, you can see that you would still make a $400 return. If you compare that to the worst-case scenario of a traditional qualified retirement plan, such as a 401k, where you could lose as much as 40% in a single year, like in 2008, you can begin to see that you would be much better off using an IUL policy for your retirement savings. But wait, we haven't taken a look at the best-case scenario. IUL policies also have a cap or limit to how much interest you can earn in a good market. Most IULs are capped somewhere between 10 and 14%. Let's say that you choose an IUL that has a 12% cap. You would earn a $12,000 on the full $100,000. After you subtract your 6% loan fee of $600, you would have earned a total of $11,400 even after borrowing $10,000 without any requirement of paying the loan back. There are many choices of saving money for your retirement. Why wouldn't you choose an investment that would keep your money accessible for the safety of your family? A properly designed IUL policy provides you with a guaranteed minimum return and a tax-free access to your money.